There are moments in history when authority feels serene, not aggressive, not theatrical, simply assured. Power, at its most dangerous, does not shout. It speaks calmly, with the confidence of permanence. It is in such moments that decisions are made not out of desperation, but out of certainty. Certainty that the system will endure. Certainty that influence is synonymous with control. Certainty that precedent does not apply. And it is precisely then that the foundations begin to shift. In early 2022, a decision was taken within the inner architecture of global finance. A decision that appeared measured, rational, even inevitable. No armies crossed borders. No declarations of war were made. No dramatic gestures were required. Instead, a system was engaged. A system that had long been regarded not as a tool of power, but as an organ of civilization itself. What followed was not merely an act of sanction, but a philosophical rupture, one whose consequences are still unfolding quietly, far from public spectacle. To understand why this moment matters, one must set aside the immediacy of politics and return to first principles. Civilizations endure not through force alone, but through trust. Trust in law. Trust in continuity. Trust that systems outlive conflicts. Money, at its core, is not wealth. It is belief. A shared agreement that value today will remain value tomorrow. For generations, the architecture of global finance rested upon an unspoken assumption that access to the system itself was neutral, governed by rules, not by alignment. That assumption ended the moment money ceased to be a medium and became a message. At the center of this transformation stands an entity widely misunderstood. SWIFT. It is not a bank. It does not store capital. It does not move funds. It is something far more subtle. It is language, a shared syntax through which financial institutions communicate intent, obligation, and trust, a neutral grammar of commerce, invisible precisely because it functioned so well. Remove that language, and transactions do not fail dramatically. They simply cannot occur. For decades, this linguistic layer of finance existed above politics. Conflicts came and went, but the infrastructure endured. That endurance was not accidental, it was deliberate. Civilization depends on systems that remain intact, even when states disagree. Yet in moments of supreme confidence, restraint becomes optional. When access to this system was withdrawn in 2022, the immediate effects were visible and dramatic. Markets convulsed. Analysts spoke of collapse. Commentators declared inevitability. But the more significant consequence was neither economic nor immediate. It was psychological. Because a line had been crossed. For the first time in the modern era, it became undeniable that participation in global finance was conditional, not merely on legality, but on acceptability. The implication was subtle, but profound. If access can be revoked, then neutrality is an illusion. If reserves can be frozen, then sovereignty is qualified. If systems can be weaponized, then trust must be reconsidered. This realization did not provoke outrage. It provoked reflection, and reflection, in matters of power, is far more consequential. History offers no shortage of warnings here. Every dominant financial order that confused universality with ownership eventually undermined itself. Not through rebellion, but through adaptation elsewhere. The mechanism is always the same. The center believes it is asserting control. The periphery begins to seek insulation. neutral actors quietly diversify. Alternatives emerge not to overthrow the system, but to survive without it. What appears as strength accelerates diffusion. The paradox is cruel. The more decisive the action, the more rapidly the world learns to live without it. The events of 2022 did not mark the collapse of any currency, nor the end of any system. They marked something more subtle and far more enduring. The loss of innocence. Once a system is revealed to be contingent, it can never again be regarded as absolute. Once belief becomes conditional, permanence dissolves. What followed was not resistance, but recalibration. Trade routes adjusted, settlements diversified, reserve strategies evolved. None of this required coordination. None of it required ideology. It required only prudence. The mistake often made by those at the center of power is assuming that adaptation is hostility. It is not. It is survival. The world did not respond by rejecting the existing order. It responded by preparing for a future in which that order might no longer be singular. And singularity is the essence of dominance. Once plurality becomes plausible, hegemony begins to age, quietly, invisibly, irreversibly. In the next part, we will examine the deeper historical pattern, one that has repeated with remarkable consistency across centuries. A pattern not of collapse, but of erosion, not of catastrophe, but of consequence. And once that pattern is understood, the present moment appears less exceptional and far more familiar. History, when examined without sentiment, reveals a disquieting truth. Power rarely collapses through confrontation. It unravels through misinterpretation. Those who command systems come to believe that control implies ownership, that what has been inherited can be repurposed without consequence, that instruments designed for continuity may be bent to the will of the moment. This belief has never survived contact with time. Across centuries, dominant financial orders have followed a pattern so consistent that its repetition borders on the tragic. The first stage is consolidation. A system emerges not by decree, but by utility. It is efficient, reliable, and trusted. Participation becomes voluntary because exclusion is unthinkable. In time, alternatives appear redundant. The system is no longer chosen. It is assumed. This is the apex of influence. Not because force is required, but because force is unnecessary. The second stage is assertion. At some point, usually under moral or strategic pressure, the system is repurposed. What once existed to facilitate exchange is now asked to enforce behavior. The justification is always compelling. Security, stability, order. And yet, something essential changes. The system ceases to be impartial. Its language shifts, subtly at first, from coordination to compliance. The third stage is recognition. This is the moment that matters most, and it rarely occurs at the center. It occurs at the margins. Those who observe from outside the immediate conflict begin to understand that the system no longer belongs to everyone equally. They realize that access is contingent, that participation is conditional, that reliance entails exposure. This recognition does not provoke rebellion. It provokes calculation. The fourth stage is insulation. Actors who neither oppose nor align begin to prepare. They do not withdraw dramatically. They do not announce departure. They diversify. They develop parallel mechanisms. They reduce dependency. They cultivate redundancy. This stage is almost invisible from the center. Nothing appears to change. Volumes remain high. Confidence seems intact, yet beneath the surface, the gravitational pull weakens. The final stage is diffusion. The system does not collapse. It simply ceases to dominate. It becomes one option among many. Influence persists, but leverage fades. At this point, power remains, but authority does not. What makes this cycle so enduring is that each stage appears reasonable when viewed in isolation. Consolidation is success. Assertion is responsibility. Recognition is external. Insulation is invisible. Diffusion is gradual. By the time consequences become undeniable, they are no longer reversible. This is not a story of malice. It is a story of certainty. The conviction that today's dominance guarantees tomorrow's relevance. In the early 20th century, the prevailing financial order made the same assumption. It believed that the infrastructure of global commerce could be mobilized without undermining its universality. The result was not immediate collapse, but a slow reorientation of trust. Neutral actors rebalanced. Capital sought alternative centers. Gold regained significance. By the time the transition became formal, the outcome had already been decided. The same logic applies today. The withdrawal of access from global financial infrastructure in 2022 was not merely a tactical maneuver. It was a declaration. Not in words, but in precedent. It declared that the system was no longer above politics, but within it. And once systems enter politics, they inherit its instability. The most revealing aspect of this moment was not the response of those directly affected. It was the response of those who were not. They did not protest. They did not condemn. They did not align. They adjusted. Payment structures were reassessed. Settlement currencies reconsidered. Reserve compositions quietly revised. None of this required consensus. Only foresight. Foresight, once exercised, cannot be undone. The great illusion of centralized power is the belief that adaptation elsewhere constitutes opposition. In truth, adaptation is indifference, and indifference is far more corrosive. The center continues to speak of norms, rules, and order. The periphery begins to speak a different language, not of defiance, but of optionality. Optionality is the enemy of dominance. When choice exists, coercion loses relevance. The system still functions, but it no longer commands. In the next part, we will examine the evidence of this transition, not through rhetoric, but through behavior. Because financial systems reveal their true condition, not in speeches, but in balance sheets. And it is there, quietly, that the story becomes impossible to ignore. When profound change is underway, it does not announce itself through declarations. It reveals itself through habits. Institutions speak carefully in public, but they act decisively in private. And it is in those private actions that the true direction of history may be discerned. If one wishes to understand whether a financial order remains secure, one must not listen to commentary. One must observe behavior. Consider first the conduct of central banks. For decades, reserve management followed a relatively stable logic. Liquidity, safety, and convenience dictated allocation. Instruments that offered yield and accessibility were preferred. Those that did not were tolerated only marginally. That logic has shifted. In recent years, central banks have accumulated gold at a pace unseen for half a century. This is not an ideological choice. Gold offers no return, it imposes storage costs, it complicates logistics, and yet it possesses one quality that no financial instrument can replicate. It is immune to discretion. Gold cannot be frozen by decree. It cannot be excluded from a network. It does not rely on the goodwill of a clearing system. When institutions accept inefficiency in exchange for autonomy, they are not speculating. They are hedging against a world in which access can no longer be assumed. Now consider settlement practices. For much of the modern era, global trade defaulted to a single medium of exchange, not because it was mandated, but because it was convenient. Even transactions between third parties passed through it, simply because doing otherwise was cumbersome. That convenience is being quietly abandoned. Bilateral trade increasingly settles in local currencies. Multilateral arrangements reduce reliance on intermediary units. Swap agreements bypass traditional clearing channels. Each instance is minor. Collectively, they are transformative. What matters here is not volume, but precedent. Once trade is settled outside the dominant framework, it becomes imaginable elsewhere. Imagination precedes adoption. Payment infrastructure tells a similar story. The architecture of global finance was once defined by a limited number of nodes. Messaging systems, clearing houses, correspondent networks, all concentrated. That concentration is dissolving. Regional systems proliferate. Domestic platforms acquire international reach. Redundancy replaces efficiency as the guiding principle. This is not fragmentation born of chaos. It is fragmentation born of caution. The architects of these systems are not ideologues. They are technocrats, engineers, administrators. Their mandate is continuity, and continuity now demands optionality. Perhaps the most revealing shift concerns energy. For decades, energy trade functioned as the anchor of monetary demand. Settlement conventions created structural necessity. To participate, one had to comply. That rigidity is softening. Energy is increasingly traded through bespoke arrangements. Currencies vary. Mechanisms differ. No single template dominates. This does not herald upheaval. It signals evolution. Once a system ceases to be exclusive, its leverage diminishes. Not immediately, but inevitably. The same pattern appears in portfolio composition. Institutions once held concentrated exposure without anxiety. Today, concentration invites scrutiny. Risk committees ask different questions. What happens if access is delayed? What happens if settlement is denied? What happens if neutrality dissolves? These questions would have been unthinkable a decade ago. They are now routine. And routine questions produce structural change. It is essential to understand that none of this reflects hostility. It reflects maturity. The world has learned that dependence carries cost. And cost, once recognized, alters behavior permanently. The illusion that dominance persists indefinitely rests on the assumption that alternatives remain inferior. That assumption fails once alternatives become sufficient. They need not be elegant. They need only function. At that moment, loyalty gives way to calculation. Calculation is not betrayal. It is rationality. History records this transition with remarkable consistency. The center continues to speak with confidence. The system continues to operate. Volumes remain substantial. Yet beneath the surface, the architecture changes. Trust redistributes. And redistributed trust does not return to its original configuration. The most subtle consequence of this shift is psychological. Once institutions internalize the possibility of exclusion, they can never again act as though inclusion is guaranteed. The future becomes conditional. And conditional futures demand contingency planning. This is why the transformation underway is so difficult to reverse. It does not rely on ideology. It does not require coordination. It does not depend on leadership. It is embedded in process. In the final part, we will step back from data and mechanics and consider the broader implication. What it means for a civilization when the systems it relied upon for continuity become instruments of discretion. and why the greatest risk to power is not resistance, but the quiet withdrawal of belief. Civilizations rarely recognize the moment they pass from command to negotiation. Power does not announce its retreat. It simply discovers that it must persuade where it once instructed. This transition is not dramatic. It does not resemble defeat. There are no ceremonies, no declarations, no visible loss of prestige. There is only a gradual narrowing of certainty. The defining characteristic of a dominant financial order is not strength, but inevitability, the sense that participation is not a choice, but a condition of existence. Once that sense dissolves, the system remains, but its authority does not. This is the stage now unfolding. Not collapse, not crisis, but adjustment. The most uncomfortable aspect of adjustment is not economic. It is psychological. For generations, the prevailing order was structured around the assumption that liquidity would always be abundant, that deficits would always be absorbable, that imbalances could persist without consequence. These assumptions were not reckless. They were logical within a system that commanded universal trust. But trust, once rendered conditional, cannot sustain such asymmetries indefinitely. When reserve currencies are no longer indispensable, borrowing becomes negotiation rather than entitlement. When settlement systems are no longer singular, access becomes privilege rather than presumption. When alternatives exist, even imperfect ones, leverage diminishes. This is not the end of influence. It is the end of exemption. In such moments, societies often search for culprits. They look outward. They invoke rivalry. They speak of decline, imposed rather than chosen. History suggests a quieter explanation. Systems undermine themselves when they are asked to perform functions they were never designed to fulfill. Financial infrastructure exists to facilitate continuity. When repurposed to enforce compliance, it inherits the fragility of politics. Politics is cyclical. Infrastructure must not be. The tragedy is not that power was exercised, it is that restraint was abandoned. Once neutrality is breached, neutrality cannot be restored by reassurance, only by time, and time rarely favors those accustomed to command. What emerges in its place is not chaos, but plurality. A world in which no single currency defines settlement. A world in which no single system defines access. A world in which influence is negotiated rather than assumed. Such a world is less elegant, but it is more resilient. And resilience, in an age of uncertainty, is the ultimate currency. The lesson here is not moral. It is structural. Power that depends on trust must preserve the conditions of trust above all else. The moment trust is subordinated to advantage, advantage becomes temporary. The irony is difficult to escape. The architecture of global finance did not fail because it was challenged. It weakened because it was used too confidently. History does not record this as folly. It records it as inevitability. The same pattern has repeated whenever universality is mistaken for possession, and it will repeat again elsewhere under different names. The events set in motion in 2022 will not be remembered for their immediate effects. Those were transient. They will be remembered for what they revealed, that no system, however vast, remains eternal once belief becomes conditional. That power exercised without regard for continuity invites its own dilution, and that the most decisive shifts in history occur not through force, but through quiet reallocation of trust. If you have followed this argument to its conclusion, you have already done something rare. You have resisted the comfort of slogans. You have chosen structure over sentiment. You have allowed history to speak in patterns rather than headlines. Such understanding is not urgent. It is enduring. If this reflection resonated not as provocation but as perspective, then its value lies not in agreement, but in consideration. A measured response, a thoughtful note, signals that depth still has a place in public discourse. And if there is someone whose judgment you respect, someone with whom disagreement sharpens rather than diminishes understanding, sharing this analysis may lead to a conversation worthy of both minds. That is how ideas persist, not through insistence, but through contemplation.